Welcome to the Commercial Know-How podcast, where mortgage brokers learn how to successfully launch, manage and grow a commercial finance business. I'm your host, Belinda Gibson. Join me as I draw on more than 25 years of property finance expertise to show you how to diversify beyond residential and build a growing business for all seasons. Don't forget to hit subscribe and visit commercialknowhow.com.au to download my free ebook to help you get started in commercial finance. Now, sit back and enjoy the episode. Hello and welcome back to Commercial Know-How. Today we're going to be talking about lending value ratios and more particular in the commercial space. So today we'll discuss 8 topics around LVR and provide you with a few tips along the way. Now, being Resi brokers, you'll be familiar with the acronym, but today we just want to concentrate on the commercial space and how it applies. So the first one is understanding LVR. So LVR is expressed as a percentage calculated by dividing the loan amount by the property value. So very simple. If you are buying a property for $500,000 and you are applying for a loan of $400,000, the LVR would be 80%. Nice and easy. And number 2 is the importance of LVR for lenders. So lenders consider the LVR when they are determining the interest rate, the loan term, and eligibility criteria for borrowers. Higher LVRs typically indicate higher risk as borrowers have less equity in the property, making it less likely for them to recover their investment if the borrower defaults. So again, you'll be familiar with this from being in the Resi space. Now, tip here, in commercial lending, you may pay a higher interest rate for a higher LVR. In the SME space or under $1 million space, banks may also favour principal and interest repayments over interest-only repayments if you are after that higher end LVR. Number 3 is maximum LVR. So lenders will typically have a maximum LVR limit that will determine the maximum loan amount they are willing to offer against a commercial property. Now, it will vary depending on the type of property, the loan purpose, and the borrower's financial situation. In the sub-1 million space or SME space, in the last 3 to 4 years, we have started to see higher LVRs on offer and longer loan terms, particularly if your client can pay principal and interest repayments. 65% was once a standard LVR for commercial. When we're looking at the commercial space, so anything greater than 1 million, we are starting to see higher LVRs like 70% and even 80% with some lenders, but it does really come down to the security that's on offer itself. Number 4 is LVR thresholds. So lenders will often set different LVR thresholds that can impact your borrower's financial arrangements. So for example, one lender may be able to offer 100% against a residential property being used for medical premises. On the flip side of this, they may only offer 50% on a motel offering accommodation. But these types of LVR thresholds will vary from lender to lender around their appetite for the type of industry. The property type also plays a crucial role in the security risk of the property, and if it's deemed to be specialised. Now, the property type can impact the lending value ratio and lender's appetite. Now, for example, if the property is deemed to be standard, so think about shops, retail, office, factory, warehouse, industrial, medical, or consulting suites, these types of properties can often result in higher LVRs, again, depending on the lender. But if we're talking about specialised properties, so hotels, motels, leisure, so things like caravan parks, petrol stations, or childcare, these can often result in lower LVRs because they're more specialised in nature. They may take a longer time to sell, as an example. One thing I do want to stress though, and I do get asked this quite a lot, LMI is not available in the commercial space. This is Resi only. So if your client needs a higher LVR, you need to consider things like equity release from another property, if that's available. Banks will consider higher LVRs for medico transactions or industries that they're more comfortable with. But thinking outside the box, if your client has a really strong cash flow, there are lenders who will do cash flow lending, which may result in a lot higher LVR, maybe even 100% if their business is really strong, highly profitable, and they're in a particular industry. And so, for example, you might have a wholesale business that wants to buy commercial premises. They've got a really good customer base. Their stock is turning over really quickly. That might be of interest to a commercial lender where they're prepared to offer more, but they might split your transaction into two, but it will give you the cash that you need to settle on the commercial property. Number 5 is reducing LVR. So to decrease the LVR, borrowers can either increase their deposit or pay down the principal loan amount. Now, this will increase the borrower's equity in the property, which will reduce their risk profile with a lender, and it may enable them to access better interest rates or loan terms in the future. Now, if you are looking for a higher LVR, a bank may be able to offer this. So they might offer you, say, for example, if you are looking for an 85 or an 80% lending value ratio, but your bank is only able to offer 65% against that standard LVR that they have on offer, they might split the loan in two. So, for example, if it's $1 million purchase, your client's looking for $850,000, but the bank is only prepared to lend you $650,000 against that property. The difference there being $200,000, they might split the loan into two. We've got the $200,000 in additional funding, repayable principal and interest over 3 years. The remaining $650,000 might be interest only for 3 years. Once you're back under their LVR threshold, you may be able to attract some better interest rates or loan terms from that particular lender, or there may be an opportunity to refinance once that additional debt's been repaid so that you can then access better interest rates or loan terms for that particular client. Number 6 is risks and benefits. So low LVRs provide lenders with more security, but they may require a larger deposit from the borrower. So higher LVRs allow borrowers to secure a loan with a smaller deposit, but they may face higher interest rates like risk fees or interest rate margins. Additional costs could also apply. Some lenders, now there are lenders in the marketplace who will consider the strength of the transaction and the borrower rather than assigning a flat LVR to your transaction. So for lenders like the one that I'm thinking of, this is where your 5 C's of credit come into play, because we want to look at the character of the client, how long they've been in business for, what sort of operation are they running, what are they trying to achieve. So the strengths of the transaction can play to your favor. Number 7 is the impact on property investors. So LVRs are particularly relevant for property investors looking to buy multiple properties. Lenders may have stricter LVR limits for investors, requiring them to have lower LVRs than owner-occupiers. Now, one policy that comes in mind here to me is specialised policy that lenders have around lease stock, where they just consider the rental income around the capacity to repay, but they do restrict the lending value ratio to 65%. Now, that might be across the board, but it is quite common. So this is where we do have to consider the impact on a property investor if we are looking at a specialised policy like a lease stock. Number 8 is professional advice. So it's advisable that your clients seek professional advice from their accountant, solicitor, or financial advisor if applicable, and you yourself as their mortgage broker to fully understand their borrowing needs, lender-specific LVR requirements, their loan options, and applicable regulations based on their circumstances. Remember to ask questions. So LVRs are just one aspect lenders consider when assessing loan applications. Other factors like income, credit history, security, lease term, and stability play a crucial role. So go back to the 5 C's of credit. Policy differs from lender to lender. It's not a one-size-fits-all approach, and each scenario is unique. Thank you for listening to the Commercial Know-How podcast. Don't forget to visit commercialknowhow.com.au, where you can download my free ebook to help you get started in commercial finance. And to also get in touch with me, make sure you subscribe on your favourite podcast player so you don't miss an episode. See you soon. Thanks for listening to the Commercial Know-How podcast. Don't forget to visit commercialknowhow.com.au, where you can get in touch with me or download my free ebook to help you get started in the commercial lending space. If you enjoy the show, please hit subscribe so you don't miss an episode. See you soon.